Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letters CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Welcome to another episode of Reverse Mortgage Radio. Very glad you could join me today. Earlier this week, I had a brunch with a customer of mine. He took out a reverse mortgage just about 4 years ago in 2020. And we were meeting with some other people that he invited because he wanted them to be aware of the reverse mortgage since they're going to be helping him take over the loan when he passes away or what have you. And he was just raving about how much he loved the reverse mortgage line of credit. So I thought, it's been a while since we've talked about that on the radio show. Let's give it a go. But as you know, if you've listened to this show before, I always like to talk a little bit about the basics of reverse mortgages. Number one, a reverse mortgage is most often an FHA insured loan. So it's insured by the Federal Housing Administration, and it's a loan that's specifically designed for people that are 62 and over. Now, there are programs for younger people down to age 55, actually, but those are called proprietary loans. And today, I want to focus on the line of credit that is part of the FHA reverse mortgage loan, because that line of credit is far and away superior to any other type of line of credit in a reverse mortgage or any other line of credit, period, actually. And we're going to do a little comparison to a normal home equity line of credit, and you'll see the benefits don't match at all. A reverse mortgage line of credit far outweighs the traditional HELOC. But the FHA insured reverse mortgage loan is specifically designed for people that are 62 and over. It allows you to convert a portion of the value of your home into money that you can then use. If you don't happen to use it all up, say to pay off an existing mortgage or get additional cash out up front, then what's left over can be set aside in a line of credit. Well, you know what? Let me back up a little bit, because essentially the way it works is FHA dictates to us, the lender, me, the lender, as to how much we can loan. And it's based on three factors. Number one is the age of the youngest homeowner. Number two is the value of the home. And number three is the interest rate. As a general rule of thumb, the older you are, the more money we can loan as a percentage of the value of your home. The lower the interest rate is, the more money we can loan as a percentage of the value of the home as well. Right now, unfortunately, with rates being on the high side, even though they have come down, they've come down a bit over the last few weeks, which is great news for a lot of people. But since the rates are still on the higher side, we don't loan 60 or 70% of the value. Typically, we're going to loan somewhere between the low to mid 30% of the value to 50 or 55% of the value. If you're up in your mid or late 80s, you can get close to 60%. So that's kind of one of the downsides of reverse mortgages, is we don't leave you a ton of money up front. But let's say, for example, you've got a $600,000 home and we can loan you $250,000 on that $600,000 home. But you only have a $100,000 mortgage. That's all you want. You want to pay off your mortgage and that's it. We pay off the existing mortgage on your home. So then you have no mortgage payment. No payment is due with a reverse mortgage. However, the home stays in your name. It's still your house. You have to pay your own property taxes and your own homeowner's insurance. You have to maintain the home and live there as your primary residence. This loan is only available for people who live in their home as their primary residence. And then also you have to keep your name on title. As long as you do those 5 things, no payment is ever required. It's an optional payment. You can make payments. So we're going to talk a little bit about the benefits of doing that when you have money set aside in a line of credit. So in this scenario, you've got $250 available, but you only need $100. That means you're leaving $150,000 set aside. Now, if you wanted to receive a monthly payment from that, you can. We could take that money and put it in almost like an annuity type situation where we pay you every month. We deposit $500, $800, $1,000, and part of that is based on how old you are. If you're 85 years old, you're going to get a lot more money on a monthly basis than you would if you're 65 years old, because the money it doesn't have to last as long for the 85-year-old. To be blunt, you'll be receiving that money over a shorter time. But what most people do is sometimes a combination. You could do a combination where you take some in a monthly payment and you leave some in a line of credit. By far and away, though, the majority of people will just leave that money in a line of credit. And that money will sit there. It's not charged interest. In fact, the opposite. You're gaining money. It grows over time. That's kind of the whole concept of the reverse mortgage, is the older you get, the more money we can loan, right? So the way the government looks at this, the way it was set up, which is really brilliant if you think about it, imagine that. The government did something brilliant. I find it baffling. But what happens is the older you are, the more money you can get. So as you age, a year, 2 years, 5 years down the road, you should be able to draw more money out if you don't take it all today. And that's the concept around the growth of the line of credit, because you're going to keep the money over a shorter term if you pull the money out when you're 75 as compared to when you're 65. It makes a lot of sense. So there's a number of benefits about the home equity line of credit, the reverse mortgage line of credit. And what I want to do is kind of go over some of those benefits, because I'm kind of jumping around here. But before we do that, let me explain. If you have any questions about reverse mortgages, please call me. You can reach me directly at 303-467-7821. 303-467-7821. My name is Bruce Simmons. I'm the reverse mortgage manager for American Liberty Mortgage here in Denver, and I've been specializing in reverse mortgages for over 20 years now. That's the only loan that I do. And what I want to do is I'm going to be actually reading a little bit from the book by Dan Hultquist that I quote seemingly every other week on this show, but it's a fantastic book called Understanding Reverse. He talks about 7 different advantages of the line of credit. And I'm not going to focus on all of them. But number one, he says here, the funds that are left in the line of credit, they don't hurt the homeowner. What he means by that is they do not accrue interest or any other charges like mortgage insurance. Those are charges that you're charged on money you've used. So the way the reverse mortgage works is you're still charged interest even though you don't have to make a payment. But the interest you're charged gets added to your loan balance. You're not required to pay it. Every month you get a statement in the mail, and you're going to see that balance getting larger and larger because the money that you've taken out, you're still charged interest. So that interest gets added on a monthly basis. Conversely, the line of credit, one of the other benefits is that it grows over time. It gets larger. So that's the most compelling feature of the reverse mortgage, is the ability for the line of credit to grow. It grows at the same compounding rate as the loan balance. Basically, the way the loan balance grows is you're charged interest every month, and then you're charged 0.5% of the loan balance per year in mortgage insurance. So if your interest rate is 7% on the loan, you're being charged 7.5% total, because 0.5% is being added on for mortgage insurance. Well, the nice thing is that your line of credit is also growing at 7.5%. They grow at the same rate. And this customer who I met with for lunch earlier, he was so excited because he's looking at his loan balance growing a little bit. When he took out the loan, he started off with like a $70,000 balance. And 4 years later now, he's got about an $87,000 balance is what he owes on the loan. It's grown by, 50%, $15,000 or $20,000. But his line of credit that started out at like 175 or whatever has grown to well over 200,000 now. He has like $212,000 in his line of credit. And he was looking at his statement. He says, man, I wish that interest rate was higher, because then his growth on the line of credit would be higher. Because if he's being charged 7.5% interest on his loan balance total, his line of credit's going to grow at 7.5%. But he was on a little bit of a different program because things change in the reverse mortgage world, and his loan only adjusts once a year. Now his interest rate is actually going to be going up next month because it's based on last year's or accumulation of rates over the years. Even though now the rates are trending down, he's like, I don't care. I want my line of credit to grow. He's excited that it's growing by $1,100 a month. That's one of the beauties of the reverse mortgage line of credit. Now, a couple other things that I wanted to touch on. It's basically one of the ways to look at it. The line of credit growth is not interest you're earning. I want to be very clear on this, because you're not earning interest on the reverse mortgage. It's just increasing the amount of equity you can draw from. Think of it like Dan Holquist says in his book. He says it's liquid home equity. It means it's easily converted to cash. The funds that are requested from the home equity conversion mortgage, which is the name of the FHA Insured loan, they have to be deposited in your bank account within 5 business days. When you request the money, the lender receives the request. You can do it by email or mail it in, or you can do a fax as well. But the lender has 5 business days from the date they receive the request to put that money into your bank account. If they don't do that, they owe you a late charge. Imagine that. Imagine getting a late charge from your mortgage servicer, one where you, instead of being charged something. And the nice thing too is when you draw the money out, it's not taxed. It's considered loan proceeds. It is not taxed like income is. If you've got it's comparison. Let's say you've got $100,000 in an IRA or a CD. Let's use CD, and it's growing at 5%. A year from now, you're going to have $105,000. Woohoo! You can take that $5,000 out, roll the $100,000 over again, and you've got that $5,000. But guess what? You're going to be taxed on that $5,000. Now, the nice thing is it never has to be repaid because it's your money. But you're not going to get a full $5,000. If you have $100,000 in the line of credit, it's growing more than what a bank is going to pay. So it's growing at, say, 7% or 7.5%. So a year from now, you're going to have roughly $107,000 plus. If you pull that $7,000 out, you're not taxed on it. But what happens is that $7,000 gets moved over to the loan balance. Now your loan balance has grown by $7,000, and you're going to get charged interest on it. Pros and cons both ways, with depending on how you want to look at it. But if you're not interested in ever having to pay back the loan, this is a great option for you. Keep that in mind. Also, too, it's secure. The line of credit can never be closed as long as you do those 5 things we talked about. Live in the home as your primary residence, pay the property taxes, pay the homeowner's insurance, maintain the home, and keep your name on title. As long as you do those things, that line of credit will always be available unless you use it all, of course. But the nice thing is you can use some, and it pays, and it draws it down, and then you wait a couple years and it's back. You now have more money than you did after you drew that money out before. And you can also repay it too. But let's go back to the other one, because it's 100% guaranteed by FHA. If the lender goes out of business, your loan is still available to you. You still have $100,000 or $150,000 or $200,000 available in your line of credit. You can draw from it. FHA will guarantee that money. The other thing is, let's say 2008 happens again. Boom, your value drops by 40% overnight, or in the next year, let's say. And you've got a traditional home equity line of credit. That bank is going to close that line of credit out quick as a wick. They're going to close it out just like that, because they're the underlying asset that secures their loan has dropped in value and it's no longer worth what it was before. So they close out the line of credit or limit dramatically the amount of money that's available to you. That cannot happen with a reverse mortgage. You could actually owe more on the house than it's really worth. Let's say that $600,000 home is now only worth $300,000, but you owe $350,000 on the reverse mortgage, and you still have $50,000 left in your line of credit. You can draw that money from your line of credit. Imagine that. Even though you're upside down on the house, you can still have access to the money. Or if you're receiving it as a monthly payment, every month they're depositing $1,000 in your bank account. It doesn't matter what the value is. So basically, you're protecting your equity in that it's going to be available to you. Okay, that's very, very important. It's 100% secured and available to you. Keep all that in mind. Those are the big factors that I think are important. Now, what if you decide to make a payment on the reverse mortgage? I've had customers do this where, let's say you're still working, but you're planning for your retirement. I'm going to do this, I think, when I get old enough and do a reverse mortgage and a house that I'm going to do a reverse for purchase, where I buy a house and I'm going to overfund it. Let's say, for example, I cash out $600,000 on my house and I can buy a new $700,000 home and I get a reverse mortgage on it. The reverse mortgage, say for this $700,000 home, let's say I can get $450,000 from the reverse mortgage. That means I only have to bring in $450,000. I can get $250,000 from the reverse mortgage. And let's say I don't want $250,000. I only want to bring or get $100,000 from the reverse mortgage because I have $600,000 from the sale of my house. I put it all into the new house and only take $100,000 out from the reverse mortgage to buy the new home. Well, then I still have $150,000 left over in a line of credit. That's part of my financial retirement plan. And I'm going to continue working. I'll probably be working when I do this. So when I won't have a mortgage payment required, but I may put in $1,000 or $2,000 every month. And what that'll do is it will increase the amount of equity I have in the home, number one, but it will also increase the line of credit that I have available for me down the road once I do retire and stop working and I need some additional money. And it's going to actually be better for me because I'll have more equity in my home. Also, too, that money that's available to me will be tax-free. Granted, it's my own equity I'm going to be drawing out. What I'm doing is just keeping my home liquid so that I can benefit from it. By the way, too, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Manager with American Liberty Mortgage in Denver. My number is 303-467-7821. You can also visit me online at reversemortgageradio.net. Reversemortgageradio.net is my website, and you can download my consumer guide. I've got a very thorough consumer guide available on my website, and I believe probably by early this week, I know I said last week it'd be available, I'm going to have those buttons on where you can get a free quote. You can also upload documents to me if you wanted to send a mortgage statement for me to review or anything like that. You can upload that if you have an electronic version of it right there on my website. Keep that in mind. You can even apply on the loan. It's technically not a full application, but it'll give me all the information I need to let you know, yes, I can do this or not, and then we can meet to sign the actual application. I'm entering the 21st century finally. But now, what I like to do, we're talking about the line of credit, and we've talked about some of the benefits, like the security of it being FHA insured, that it's always going to be available. It's a non-recourse loan, meaning that you can always have that money available to you, even if you're upside down on the house. It also grows over time. The line of credit grows. So let's compare it to a traditional HELOC, a home equity line of credit you'd go get at your bank. Now, number one, the first thing I do need to mention is a traditional home equity line of credit is less expensive to get set up. A reverse mortgage does have more upfront closing costs. However, those are not cost out of your pocket. You're not having to pay those back as long as you live in your home. You're charged interest on them because we will roll them into the loan. So there's pros and cons in that respect. But it is, number one is most HELOCs, traditional HELOCs at the bank, are not FHA approved. They're not going to grow over time. If you get a $50,000 HELOC, it's going to stay $50,000 available to you. If you use it all up, well, there's no more money available to you. Also, too, like I mentioned before, it can be frozen or closed on a moment's notice, really. It doesn't even need to have the equity drop, like the value drop. If you found yourself in a financial pickle, or you drew out a lot of money and they reevaluated your credit worthiness, they could close that line out in a moment's notice as well. It does also require a monthly payment. A traditional HELOC, you do have to pay at least interest-only payments every month. That's a requirement. And those payments go up if the interest rate goes up or if you take more money out. So you got to keep that in mind. A lot of people are hesitant to use it because they don't want to be charged a higher payment. And also, too, right now, the interest rates are higher than on a HELOC than a conventional loan. I think most HELOCs are in the 9.5% range, whereas a home equity conversion mortgage is in the 7s, sometimes even the 6s. So it just depends on the situation. But you've got to be aware that you're still having to make a payment. Also, the traditional HELOC is typically only good for like 10 years. And if you want to re-extend it, then you have to make payments on it. You have to requalify to get it. For example, I did a loan for a customer, a realtor. He only owed like less than $30,000 on this home equity line of credit loan that he had at a big bank. It's a big bank that I used to work for that I refer to as the evil empire. He was a realtor. When he got the loan, he was still working. After 10 years, he'd been making payments on it, interest-only payments, but now his income had shrunk dramatically, and he was making like $1,200 a month or something on Social Security. Even though he had other assets, that was all his income. The bank would not requalify him, and then what they do is they do something called they reset or recalculate it. So now he has to pay principal and interest, both. So his payment goes up when he could least afford it. And we were able to do a reverse mortgage for him. We paid off that loan, and he had a new line of credit. Now, one of the things, too, to keep in mind is because we don't loan a huge percentage of the value of the home, you do have to have a lot of equity in your home in order to qualify with enough money to get a line of credit. For example, if you have a $200,000 mortgage on your home and we can only loan you $200,000, well, we're going to loan you enough to pay off that existing loan, so you're going to save the principal and interest payment, but you're not going to have any line of credit remaining after that because there's just no more money left over in that situation. All the money's going to pay your existing mortgage, which is the benefit. That's a huge benefit. It might save you $1,000 or $1,500 in principal and interest payments, but you're just not going to have access to additional money because you're using all the money to pay the taxes and insurance. So those are the big things that I want to compare. Comparing a reverse mortgage line of credit to a traditional HELOC, and now, one thing to keep in mind, both traditional HELOC and a reverse mortgage line of credit are only available with adjustable rate loans. So if you call me and you say, hey, I want a fixed rate loan, but I want that line of credit, you can't do it. It's not available. It's only available on adjustable rate loans. And actually right now, 100% of my customers are all taking an adjustable rate loan because interest rates are going to come down. They've been trending down over the last couple of weeks, and I think they're going to continue to come down, hopefully a little bit. Now, I do want to make sure that you understand where I'm coming from on interest rates. I think rates are probably going to be bouncing between 6 and 8% for a long time. I don't think we're not going to see that 5 or 4%, especially not 4%. I don't think anytime soon. So rates, I think, are going to be bouncing my guess is maybe they will dip below 6%, but then they're going to come back up and they'll climb back up and they may touch 8% again and then come back down to 6. I think we're going to be in that trajectory of interest rates for a while. And also too, keep in mind how we talked about it last week. The market expects certain things from the Federal Reserve. If the Federal Reserve does not deliver those things, interest rates could go up, even if the Federal Reserve lowers rates. If the Federal Reserve does not lower rates as much as the market anticipates and has already built in to the current rates, then we could see interest rates go up when the Federal Reserve reduces rates. It's kind of a quandary, but that's how it works. And as those rates change, it can benefit you if you have a line of credit with a reverse mortgage. Because if the rate goes up, the growth rate on your line of credit will go up and your line of credit will grow faster. Of course, your loan balance will also grow faster. But if you decide you want to make a payment on the reverse mortgage, you can pay, if you pay $1,000 towards your loan balance, that $1,000 is going to reduce your loan balance by $1,000. It's also going to increase the line of credit by $1,000. You're not throwing money down a hole. It's not just reducing your loan balance and then you have no access to it. It's a revolving line of credit. So if you pay money in, if you decide you get a tax refund next year and you can put $10,000 in, that's awesome. It'll lower your loan balance by $10,000 and it'll increase your line of credit by $10,000. So you can have access to that money later. Actually, you'll have access to more money than you put in because that extra $10,000 you put in is going to grow over time. And you're going to have access to more equity than you did at the time you put the $10,000 in. So you want to keep all these things in mind. There's a ton of benefits from the reverse mortgage line of credit. That's what the main focus of this show is. And I just think it's a fantastic option for a lot of people. And that's why I call it a financial planning tool a lot of times. You could use a line of credit if the stock market is down and you have assets in the stock market that you now want to spend, but you don't want to take them out when they're at a depreciated value and pay taxes on them to boot. So you tap into the line of credit. If the stock market bounces back, you can sell your assets and you can even pay back the reverse mortgage so that you'll have more money available to you down the road. Or if you have a required minimum distribution and you don't know what to do with that extra money, you could put it towards the loan balance of the reverse mortgage and still have access to it. There's even tax benefits to that strategy, which we don't have time to get into today. But keep in mind, a reverse mortgage is a great option dependent upon your situation, and I'd love to talk with you about your specific situation. Give me a call. You can reach me directly at 303-467-7821. 303-467-7821. My name is Bruce Simmons, or you can visit me online at reversemortgageradio.net. Go there and download my consumer guide. 303-467-7821 is my number. I'd love to talk with you about your situation, and thank you so much for joining me today. You have a fantastic day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.